also a tax partner at Scotland Land, and today we'll be talking about the latest changes to the tax reporting of disposals of residential property. Okay, the key aspects of the new regime is that it requires you to do two things. Make the report of a capital gain arising from the sale of residential property, which needs to be done within 30 days of the sale of the property. Sorry, bear with me. Yeah, so there's a 30-day deadline to make the report to HMRC and pay the tax on the residential property gain. This deadline was introduced for transactions which take place on or after the 6th of April this year. And as I said, the 30-day period runs from the date of completion and not the date of exchange of contracts. And the key points are that these reporting requirements apply where you have residential property, a gain arises and tax is due. If no tax is due on that transaction, then there's no need to do a 30-day reporting. And any reporting that's made within these new rules are then later reconciled with your tax return, as even though you have to do the 30-day reporting, you would still have to include the gain realised in your tax return, but get credit for any tax that you've paid within 30 days against the tax liability arising through your tax return. So when we talk about residential property, what we mean is land which has consisted of or included a dwelling at any time, but it also applies to where you've got the benefit of an off-plan purchase contract. So the key thing is there usually has to be a dwelling. So, and what we mean by that, it's either used as a dwelling or suitable for use as a dwelling. Now, in terms of if you were selling some garden land, that would not be included within this new regime, because the key aspect is it's got to involve a sale of a dwelling or a disposal of a dwelling. As I say, a transfer of a home which doesn't generate a tax liability, that doesn't need to be reported within 30 days. So for instance, if the gain that you realise is covered by your annual exemption, or it's covered by principal private residence relief in full, then there's no need to report that within 30 days. Now, the new regime, as you will have gathered, will extend to a wide range of disposals, whether that be buy-to-let properties, holiday lets, holiday homes, or homes which are inherited. And it's not just sales of properties. So if you had a family gift which generated a capital gain, then that would also need to be reported as if it was a sale. And the regime doesn't apply to trading transactions. So if you bought the property, redeveloped it, and then sold it and reported that as a trading income, then that would not be covered within these new rules and just needs to be reported in the usual way. Also, the regime doesn't apply to overseas homes. Now, prior to making the report, there'll need to be a calculation of the capital gain. and you'll need to gather information from your records about the costs and also what you received for the property, because that is the type of information that's required to calculate the gain. And also any other relevant details, such as any reliefs, any tax reliefs you may be entitled to. So given the narrow window, it's very important that at an early stage of the transaction that you start to gather this information. Now, HMRC provide an online facility to enable you to report the gain, and you will need a government gateway user ID and password. If you don't have this, then you can create this when you report and pay. You can upload a PDF or JPEG file showing how you've calculated the capital gain, but from our experience, the online facility provides enough prompts to enable that information to be obtained without needing to upload a separate PDF or JPEG file. Now, after the gain has been reported, HMRC will issue a payment reference, which will then allow you to make payment. So you wouldn't make any payment until you have that payment reference, because the payment reference allows HMRC to match what you've paid against what is being reported. Now, if you fail to comply with these new rules, then there's going to be interest for late payment of tax and also penalties. However, if a disposal had occurred at any time prior to the 1st of July this year, then there is an extension to the 30-day window, as long as the reporting is done by the 31st of July this year. So the report can be submitted by you as a taxpayer or by the taxpayer's agent, but it's really important that if you would like the agent to submit on your behalf, then you must set up an online capital gains tax account and authorise the agent online. Even though your agent may have a general authority to submit tax returns on your behalf, that won't be enough in this instance. You need to set this authority up to submit the 30-day reporting as a separate specific thing, which you can do, which you should be able to do through the online capital gains tax account. There are a few problems with reporting at the moment, particularly where we have disposals by executors, and I think it's still a very new regime, so it will take a bit of time for the systems to work perfectly. Now, if you do submit an annual tax return, you will still need to include the capital gain in your tax return, even though you've reported the gain and paid the tax within 30 days. As I said, you'll get credit for any tax that you've paid within the 30-day window. Now, if you don't normally submit an annual tax return, just because you've realised a gain from the sale of residential property doesn't mean that you now have to do a tax return, because the 30-day reporting process should enable you to satisfy your tax obligations sufficiently. Now, there's just a few points to watch out for. As I said, disposals of homes by way of gift are caught by the new regime. So where you've got transfers between family members, they're generally deemed to take place as if you'd sold it at market value. So if that gift produces a tax liability, then that must be reported within the 30-day window. Even if you've got a home, even if you're selling a home that you have lived in the past, if you previously let it out or haven't lived in it throughout your period of ownership, there could be a taxable gain which may need to be reported. And also, if you've got mixed-use property, you'll need some kind of value apportionment made to determine what element of the transaction and the gain relates to the dwelling. Okay, I'll now pass you over to Faye Howard.
Thank you, Gavin. For those of you who don't know me, my name is Faye Howard and I'm a private client tax partner based in our Ipswich office. Although, like most of the rest of the world at the moment, I am working from home currently. So please don't excuse any animal noises which may happen in the background. I think the first thing to say about this new reporting regime is that one of the biggest difficulties is quantifying how much capital gains tax you've got to pay, because you're making a disposal and reporting it in the middle of a tax year, and potentially you don't know what your income is going to be for that tax year, and you don't know what your capital position is going to be if you've got other transactions planned. So what we are sort of saying to people where they're making these disposals is do talk to us early, because, for example, if you're looking at making other disposals of assets during the year, and perhaps those disposals may result in a capital loss, then if you can make that loss before you make the capital gain on the residential property, you'll be able to take that loss into account when filling in this form and quantifying the amount of capital gains tax due. What you can't do is take into account any capital losses which are planned but haven't yet arisen. So potentially there's a cash flow advantage there if you're able to structure things in such a way that you're realising the losses before you're making the gains. And of course, it's going to be a case of estimating what your income is for the tax year in which the gain arises, because capital gains tax is calculated essentially as on top of your income. So to work out your capital gains tax rate, we look at your income, and then if any of the basic rate tax band is free, any residential property gains that fall in that basic rate band will be taxed at 18%, and any that fall over that will be at 28%. The other point I just wanted to look at was main residence relief. Now, there were some significant changes to main residence relief, which were introduced from the 6th of April this year. Prior to that, and in fact, we do still have principal private residence relief. And principal private residence relief is fantastic because what it does is it relieves from capital gains tax any periods in which you actually owned a property as your only or main residence, and certain periods which are deemed to qualify for principal private residence relief. And the most common of those is the last period of ownership. Now, we used to get the last 36 months of ownership as deemed principal private residence. That was reduced a few years ago to the last 18 months. And from the 6th of April this year, that has been reduced further. So it's now just the last 9 months. Now, that on its own isn't, although it's not good news, of course, it's not a particularly earth-shattering change for a lot of people. The thing that is going to make the biggest difference is the changes to lettings relief. Now, lettings relief was a very useful relief, whereby if you dispose of a residential property, which has been your only or main residence at any point, you can potentially claim lettings relief. And the amount of lettings relief available was the lower of the gain relating to the let period, the amount of principal private residence relief claimed, or £40,000 per person. So potentially it's a maximum of £80,000 per couple if you own a property jointly. And if that gain falls into the higher rate band, that's £11,200 of capital gains tax each. So potentially £22,400 of capital gains tax at stake. Now, lettings relief has been changed significantly from the 6th of April this year, such that it's now only available if the property which you dispose of and which you wish to claim lettings relief on, that relief can only be claimed if you were in occupation of the property at the same time as the tenant. So essentially, if you had a lodger in your property, then potentially you would be able to claim lettings relief. But what this means is that a vast number of people who would have qualified for lettings relief previously will no longer be able to make that claim. And it's not just a period since 5th of April, it's historic. So if you now dispose of a property which previously would have qualified for lettings relief, unfortunately, you're no longer able to make that claim. And that comes into effect from the 6th of April this year. So essentially disposals now. Now, what we do have is a bit of a weird situation, really, because COVID-19 has clearly had a big effect on the property market. And, the government did ask people not to proceed with property transactions that weren't essential. And I've certainly had a couple of clients who have contacted that I'm aware of. One's my client, one was somebody else's, where they were disposing of properties and potentially there was a large amount of lettings relief at stake. Both of those sales were due to take place prior to the 5th of April, but because of COVID, they didn't. And the questions that we're being asked is, will there be any extensions to lettings relief and private residence relief? And the answer to that at the moment is we don't know. I have to say, I think it would be very difficult politically for the government to sort of extend these provisions, because where you've got a government that is strapped for cash at the moment and will in the autumn budget be looking at measures to try and recoup some of the huge expenditure that has resulted from the COVID pandemic, I think it would be politically very difficult to extend this relief to landlords and owners of second homes who, by a lot of the voting public, would be seen as elite for being in that position. So to give them a tax break is quite a difficult thing to do, I think, politically. But as things currently stand, as far as we're aware, the lettings relief and principal private residence relief changes do take effect from the 6th of April. Now, the finance bill hasn't been passed yet. We haven't heard that there will be any changes to it. We are expecting it to go through as normal, but I guess it's a case of watch this space. Now, of course, what this does mean is that if you have made a disposal and you are looking to report this, and potentially you were looking to bank the lettings relief before the 5th of April, but were unable to, what do you put on that form? I think the answer has to be, we have to assume that the lettings relief and principal private residence relief have disappeared at the 5th of April. But if you are in that position, what we are saying to affected clients is to speak to your MP, lobby them, and see if you can get any joy that way. But strictly speaking, you should be reporting the disposal without claiming those reliefs. And I have to say, it is a little bit confusing because HMRC's website does have a calculator for capital gains tax, and it does ask if you're wanting to claim lettings relief. But of course, people now are completing their 1920 tax returns, and a disposal in that year, lettings relief would apply. So that's why that is still there. But I just wanted to give an example of what these changes actually mean. So we have in this example a property which was acquired for £250,000 in June 2010. It was occupied by the owner as their main residence until June 15. Since June 15, the property has been let, and it was sold in June 2020 for £400,000. So just wanted to quantify what that difference actually looks like. So in both situations, we have a capital gain of £150,000. Under the old regime, we would have claimed 78 months of principal private residence relief, which was worth just under £96,000 of that gain. Under the new regime, we've got 9 months less, so just under £85,000 of principal private residence relief. But the biggest change here, of course, is the removal of the lettings relief. And you can see the knock-on effect that has in the capital gains tax liability, where under the old regime, that disposal would have resulted in a capital gains tax bill of £504. The new regime has increased that significantly to £14,802. Now, you're possibly sat there thinking, why on earth are you telling us this? Because it's too late to do anything about private residence relief and lettings relief. And you're right, it is too late to do anything about those particular reliefs. However, there are still options for reducing the amount of capital gains tax payable and indeed deferring it. And essentially, this can be achieved with the use of EIS, or Enterprise Investment Scheme investments. Now, these are very highly regulated investments. Specialist IFAs are the people to consult about these. And should you talk to such an IFA, they will tell you that they are high-risk investments. However, whilst they're a high-risk investment, they are also underwritten by a huge amount of tax reliefs. And the tax reliefs that you can get by investing in these particular vehicles are 30% income tax relief in the year of the investment or the previous year, 100% inheritance tax relief after 2 years. And the reason that I've included them in this presentation is because they can also defer the capital gain for the life of the EIS investment. So in that example that we've just been through, where there's £150,000 gain, if the person making that disposal invested that £150,000 gain into an EIS investment, typically the life of these investments is around about 5 years. So on putting that money in, as soon as they've got the certificate confirming that investment, they'd be able to claim 30% income tax relief in the year the money was invested or the previous year. But they would also be able to defer that capital gain. So whilst it won't give you a cash flow advantage, because you'd still have to make the report, pay the capital gains tax in your 30-day window, if you invested that gain in that tax year, you will get that capital gains tax back. So it's a great way to defer the gains. That investment, as I say, would last probably for about 5 years. At the end of that investment, you've got some options. You can either get capital back, assuming that the investment's worth what you invested in it initially, and you can reinvest, and that means that you can continue to defer that gain. You could partially crystallize the gain to use the capital gains tax annual exemption for that year and reinvest the balance. Or you could say, actually, enough, I'm going to pay the capital gains tax that's due. But on the crystallization of that investment, what you've actually got is a gain on the shares. So we're essentially converting a residential property gain at a maximum capital gains tax rate of 28% to a gain on shares at a maximum 20%. So there'll be an 8% capital gains tax saving there. I think it's fair to say that EIS investments at the moment possibly would be seen as too risky for a lot of people, but that's absolutely down to personal preference. And particularly with the market as it is at the moment, there are certainly not as many options for EIS investments we're finding. But again, I just wanted to make the point that you've actually got 3 years from the date of disposal to invest in EIS. So it's something to sort of think about over that 3-year period, because it's not a decision that needs to be made imminently. So I guess the key points really we wanted to make are that this 30-day reporting window is very limited. And particularly if you want an agent to file this return for you, by the time you set up a government gateway account, if you don't already have one, that can take up to 7 days to do. We then have to be authorised with a digital handshake. And again, it can take up to 7 days for HMRC to process agent authorisations. So I would say, to be on the safe side, you want to allow 14 days to get that authorisation in place. So for those reasons, it's really important to engage with us at an early stage. And we can, of course, if you talk to us pre the sale, we can talk to you about whether you've got other gains or losses rather that you might want to crystallise to help the cash flow position when you're making this disposal. And of course, even though you've got to report this transaction within 30 days, as Gavin said, you do still have to put it on the tax return. And the tax return is the document where essentially everything for the tax year comes out in the wash. So we'll know by the point at which the tax return is done what your income is, what your gains are, what your losses are. So we will have an accurate picture of the tax, and then any over or underpayment from the 30-day reporting will be adjusted at that point. And just the final point to make, this of course only applies to residential property. You don't have these reporting regime for non-residential property, and the rates themselves are unaffected. So I think that's pretty much all that that we have to say on this subject today. The chat box is still there if you have any questions at all, but both Gavin's and my details are up on the screen. So, you know, if you'd rather have a one-to-one chat, please do drop us an email or give us a call, and we would be very happy to talk to you. But otherwise, thank you very much for joining us this morning.